I don't know anybody who has successfully timed the market. That's what investing legend Jack Bogle said back in 2001. Ever worried you might be buying at the worst possible moment? I know I have. With markets hitting record highs and everyone panicking about the Shiller PE ratio being at 35, we face a crucial dilemma. The average investor who tries to outsmart market highs ends up earning 50% less than someone who simply stays the course. In the next few minutes, I'll explore whether buying dividend ETFs, even at market peaks, might be smarter than waiting for a crash that may never come. What if I told you the stock market is currently priced at double its historical average? The Shiller PE ratio sits at a concerning 35, far above the historical average of 17. This metric, developed by Nobel Prize-winning economist Robert Shiller, is one of the most respected valuation tools in finance. The Shiller PE, or cyclically adjusted price-to-earnings ratio, gives us a clearer picture of market valuation by averaging earnings over a 10-year period. Unlike the standard PE that only examines current earnings, this approach smooths out volatility to reveal whether stocks are historically expensive or cheap. Currently, this indicator is flashing a bright warning signal. Market history shows a consistent pattern. When the Shiller PE climbs to these heights, corrections typically follow. During the 2000 tech bubble, the ratio reached 44 before the market crashed, erasing trillions in wealth. Before the 2008 financial crisis, it rose to the high 20s, preceding a 50% market plunge. These recurring patterns throughout market history suggest that extreme valuations eventually correct themselves. For passive investors considering dividend ETFs, this creates a genuine dilemma. Investing near market peaks is like purchasing front-row tickets to a show that's about to be canceled. You pay premium prices only to experience significant disappointment. Nobody wants to commit their savings just before a major correction. This concern intensifies when examining today's most prominent stocks. The Magnificent Seven carry steep valuations. Meta and Google at PE 27, Apple 29, Microsoft 37, Tesla 45, Amazon 50, and Nvidia 62. These prices reflect optimistic future growth projections rather than current profits. Many investors naturally wonder, should I wait for prices to decrease before investing in dividend ETFs? This question becomes particularly relevant since many index funds heavily weight these potentially overvalued companies. As one investor noted, it makes it a lot harder psychologically to put money into the market right now, at all-time highs. This fear often drives investors toward market timing, waiting for prices to fall before buying. However, this approach contains a fatal flaw. Market timing requires two correct decisions: when to exit and when to re-enter. The market doesn't announce its peaks and bottoms, and emotions frequently lead to mistimed moves in both directions. Data consistently shows that timing the market based on valuation metrics alone has been a losing strategy. Studies from Morningstar and Dalbar demonstrate that investors attempting to time the market substantially underperform those who remain invested, often by several percentage points annually. Even renowned investors like Warren Buffett and Peter Lynch advise against market timing despite acknowledging overvaluation concerns. They recognize that markets can remain overvalued for years or decades, and missing those compounding periods can severely damage long-term returns. The market timing warnings from investing legends aren't just theoretical. They're backed by one of the most successful investment innovators in history. Jack Bogle, who transformed investing for everyday Americans, created an investment powerhouse that now manages over $7 trillion in assets. As the founder of Vanguard Group, Bogle revolutionized investing by creating the first index fund for individual investors, democratizing access to the markets, and championing low-cost investing principles that have helped millions build wealth. Bogle built his philosophy around helping average investors succeed in the real world. During the dot-com bubble of the late 1990s, when many experts urged caution, Bogle maintained his disciplined approach, continuing to invest systematically while acknowledging the market's elevated valuations. This real-world experience during extreme market conditions gives his insights exceptional weight, especially as we navigate today's similarly frothy markets. What's fascinating about Bogle's approach is his apparent contradiction. He recognized when markets reached concerning valuation levels, yet consistently advised investors to keep investing. This wasn't because he ignored valuation metrics. Rather, he understood something fundamental about investment success. Consistent participation matters more than perfect timing, approaching the market as a marathon rather than a sprint. In a prescient 1997 speech, when investors worried about lofty market valuations similar to today, Bogle separated returns into two components: short-term speculation versus long-term fundamentals. While speculation drives prices temporarily, he emphasized that actual dividends and earnings growth determine returns over meaningful time periods. Bogle outlined two scenarios that mirror our current situation: either a substantial market correction of 30 to 35%, or valuations remaining elevated, potentially signaling a new market era. Critically, he advised investors to stay the course, regardless of which scenario materialized. His analysis of speculation driving short-term markets directly applies to today's Magnificent Seven stocks with their sky-high valuations. The current market's concentration in technology giants exemplifies exactly the speculative behavior Bogle warned about. Yet recognizing this speculation, he still advocated staying invested. Even when Bogle personally believed markets were overvalued, he maintained investment discipline rather than attempting market timing. This wasn't blind optimism, but a clear-eyed recognition of market function and how human psychology often sabotages timing efforts. While television pundits might recommend moving to cash when markets appear expensive, Bogle maintained that consistency produces better results than trying to outsmart market cycles. In 2001, he made his position unmistakable. "I don't know anybody who has successfully timed the market." From someone with his track record, this amounts to a powerful endorsement for maintaining investment discipline, even when valuations make you nervous. Bogle's skepticism about market timing wasn't just philosophical, it was mathematical. What most investors don't realize is that successfully timing the market requires being right not once, but twice, knowing exactly when to exit and precisely when to re-enter. This double challenge creates a cost of waiting that compounds silently in the background, potentially robbing you of half your potential returns. When markets reach elevated valuations, the instinct to pause seems rational. Who wants to buy something expensive that might go on sale soon? Yet this approach carries hidden penalties that investors rarely appreciate until too late. Market timing demands extraordinary precisions at two critical moments. You must predict market declines accurately, then identify when the market has bottomed. Missing either devastates returns. It's like threading two needles while blindfolded. Dalbar's analysis confirms this struggle. Average investors significantly underperform indices because of poorly timed decisions, often selling during downturns and buying during upswings. While waiting for corrections, your cash sits idle. You miss dividend payments that could be reinvesting and compounding real company profits forfeited while on the sidelines. If markets continue rising, your opportunity cost grows exponentially with each passing month. Consider Mark, a cautious investor who moved to cash in early 2013, convinced a correction was imminent. The market surged 30% that year. As years passed and markets climbed higher, Mark's anxiety intensified. He vacillated between regret over missed gains and certainty that entering now would be foolish. Each market rise amplified his emotional torment. By 2019, he had missed a historic bull market while watching others build wealth he could have shared. The mathematical cost was enormous, but the psychological toll was devastating. This psychological trap stems from anchoring. Investors fixate on specific price points. I'll buy when the S&P returns to 3,800. But what if it never does? This anchoring keeps investors paralyzed, watching markets climb while waiting for re-entry points that never materialize. Even when corrections arrive, many investors who successfully exit still fail to capitalize. When markets plummet and headlines scream doom, fear prevents them from deploying cash. The bargains they sought slip away as markets recover, sometimes with startling speed. The evidence speaks volumes. Time invested consistently outperforms timing events. JP Morgan's analysis shows missing just 10 best market days over 20 years cuts returns in half. Missing 30 best days results in negative returns, even during generally bullish periods. Those best days often cluster around the worst days, making them impossible to capture when moving in and out of the market. Every day out of the market compounds into a mathematical penalty of missed dividends and appreciation, a silent wealth killer that leaves many investors permanently behind. The data is clear that staying invested beats trying to time the market. But what about when everything feels overpriced? Enter dollar cost saving average, a mathematical approach that automatically protects you from the consequences of buying at the wrong time, while simultaneously transforming market dips from moments of panic into valuable opportunities. Dollar cost averaging works like a subscription to stock market growth. Instead of making a one-time bet on market timing, you invest a fixed amount at regular intervals, weekly, monthly, or quarterly, regardless of market conditions. Think of it as investing on autopilot. Rather than agonizing over whether today's prices are too high, you simply commit to putting $500 into your dividend ETFs every month, regardless of market headline. This approach addresses a common investor fear. What if I invest everything today and the market crashes tomorrow? By spreading your investments over time, you protect yourself from the psychological trauma of unfortunate timing. Let's walk through a simple example to see how this works. Imagine investing $1,000 monthly in your favorite dividend ETF. In January, the ETF cost $100 per share, so your investment buys 10 shares. When February brings a market dip and the price falls to $80, your same $1,000 automatically purchases 12.5 shares, taking advantage of the lower price. Then in March, as the market rebounds to $125, your regular investment secures 8 more shares. After 3 months, you've invested $3,000 and own 30.5 shares worth $3,812.50 at the March price. The math reveals your advantage. Your average share price is $98.36, $3,000 divided by 30.5 shares, which is less than the average market price over those 3 months, $101.67. This mathematical edge occurs because you automatically buy more shares when prices are low and fewer when prices are high. The psychological benefits amplify these mathematical advantages. When markets plunge, you're mentally prepared to acquire more shares at lower prices. When markets soar, you remain disciplined and stick to your predetermined amount. The strategy effectively guards against both panic selling and FOMO buying. For dividend ETF investors, this approach offers additional power. Each dividend payment can be automatically reinvested, creating a second layer of dollar cost averaging. This accelerates your compounding, especially during market downturns when your dividends purchase shares at discount prices. Consider an investor who consistently invested $500 monthly into the Vanguard High Dividend Yield ETF through 2020. During the March crash, their regular investment secured significantly more shares than in January or December, generating greater dividend income moving forward. The strategy requires one crucial element: unwavering discipline. You must maintain your regular investments through both market highs and devastating lows, even when headlines scream about market crashes or when bull markets tempt you to invest more. That gap between knowing the right strategy and consistently executing it is precisely why we need to build an investment fortress that can withstand both market volatility and our own psychological weaknesses. Did you know that even professional fund managers frequently underperform their own funds because they make emotional timing decisions? This psychological challenge is why creating a personalized investment plan is the critical difference between success and failure when navigating uncertain markets. The most overlooked benefit of a comprehensive investment plan is psychological, the peace of mind that develops when you know you're making consistent progress regardless of market conditions. This confidence allows you to navigate volatile markets without the crushing anxiety that paralyzes many investors. Understanding dollar-cost averaging becomes actionable when you have a concrete written plan that transforms abstract financial concepts into steps you'll actually follow. Your plan serves as a guardrail when markets plummet and your instincts scream to sell everything. Think of your investment plan as building a financial fortress, with each component strengthening your defenses against both market turbulence and emotional decision-making. Let's construct it step by step. First, determine a realistic savings rate based on your current finances. Consistency beats intensity. Whether it's 10% or 30% of your income, establish a rate you can maintain through economic booms and personal challenges. Next, select your investment frequency. Weekly deposits create more averaging opportunities, while monthly investments might better align with your paycheck schedule. Third, choose appropriate dividend ETFs, matching your risk tolerance and goals. Consider diversification across market caps and sectors, rather than chasing the hottest current yield. Many investors mistakenly select ETFs based solely on yield instead of total return potential. Finally, establish timelines aligned with your life goals: college funding, retirement, financial independence, using these to guide your asset allocation decision. A crucial element is separating long-term investment capital from emergency funds. Only invest money you won't need for decades. This mental separation allows you to view downturns as buying opportunities rather than threats. Automation transforms your plan from theoretical to practical. Setting up automatic transfers removes constant decision-making that invites emotion into the process. Each automatic investment becomes a barrier against the temptation to time the market, a commitment device protecting you from future moments of weakness. Schedule quarterly reviews, focusing on progress toward goals rather than short-term performance. Ask yourself, is my plan still aligned with my long-term objectives? This shifts attention from daily market noise to meaningful progress toward financial freedom. Be prepared for inevitable market crashes. Your plan should include specific instructions for when markets drop 20%, 30%, or 50%. Having these decisions made in advance prevents panic reaction when emotions run high. We've covered a lot of ground today, but here's what it all comes down to. Consistency trumps timing. The evidence is clear that your commitment to a strategic plan matters far more than whether the market is at an all-time high. As Jack Bogle emphasized, the greatest risk isn't buying at a market peak. It's not investing at all or abandoning your strategy during volatility. This foundational principle from Vanguard's founder remains essential for successful long-term investing. Your financial future depends on establishing a disciplined approach maintainable through all market conditions. Are you ready to build your financial fortress today? Start now, stay consistent, and let time work its magic.